Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us Don Plotsky, who's the co-founder of Alternative Income Solutions. Don, welcome to the program.
Thank you, Mike.
Hey, I'm looking forward to learning from you because I love seeing people's life experience, business experience, and seeing what insights that they bring. So I'm excited to talk to you, but get us started off first with what's your entrepreneurial journey been like in what got you into the finance industry in the first place?
Right. So I've been in the finance industry for almost 40 years. Started at E.F. Hutton back in 1984.
Hey, I remember those commercials where it's like when E.F. Hutton talks, people listen.
One of the great advertising campaigns of all time.
Yes.
But really was attracted to the mathematics behind the bond market, got involved in the bond market in 84. And the bond market was a very different place in those days. Rode the tide from 1984 through 2016 working at large firms. Spent the last 14 years of that corporate journey working at Western Asset Management as head of product development, product management. But then I decided in 2016 that bonds had finished their journey. Bond yields were low, risk was high, not a good combination, and set out to invest my money and clients' money in more interesting income opportunities. And that's where we are today.
Neat. You know, I think that when you can find something that's unique and different, that's wonderful because it sets you apart, but it also is a challenge because sometimes people look at that as being new and different and going, tested, tried, true. So talk a little bit about the alternative and what is specialty finance that you focus on.
Right. So we do focus on specialty finance. The idea being that we want to identify investment opportunities where income is high. Typically in the fixed income markets, you think of high income, high risk. That is not the case in specialty finance. Very often high income is because people don't have access to traditional funding sources. So take the cannabis industry, for example. They cannot borrow from banks. Media, very often banks won't lend against certain media opportunities like royalties on a song or royalties on a movie. But those industries need financing just like any other business. So specialty finance really is about providing investments and providing financing to these entrepreneurs who are in those spaces who need capital to make money. So specialty finance.
So not necessarily high risk, just kind of really niche, ultra niche.
Right. So what we're talking about is high income, really very low risk of principal because it is not a bank serviced industry. We're able to put in place covenants that really protect us either through collateralization or through structure. So we're able to protect our investment, protect our investors, by negotiating these types of things and reducing the risk of loss. And lastly, you're not talking about a lot of volatility. These are not market priced assets where the price changes every day. These are long-term investments where you put your money in. You're talking about a 2 to 3 year investment horizon, typically in these types of investments. So you've got high yield, low risk of loss, and little or no correlation to the broad market. So it's a great tool within the portfolio.
Yeah. And you mentioned royalties. So that sounds unique. So talk a little bit about the types of opportunities there with music or media. And also I've interviewed people in the past that are like CEOs of a, uranium mine, and they provide royalties. And so tie all that together into what some of the opportunities are there, because I think that's really curious and unique. And that kind of could give an investor or an agency really a neat way to kind of hang their hat on something like, hey, this is fun to participate in because it's not just the traditional bland vanilla whatever type of fund.
Right. Well, it's about cash flows. Businesses generate cash flows. If you look at Apple, Microsoft, Intel, these companies generate enormous cash flows. But as an investor, you don't get to participate directly in those cash flows.
Yeah.
You basically participate through share ownership, and the price of the stock will go up or down depending on supply and demand. In specialty finance, you're talking about an actual business activity where there are cash flows generated on a month in, month out basis. And you're either taking ownership or providing financing and participating directly in those cash flows. So, for example, you raised media, I raised media. Let's talk a little bit about that. Somebody writes a song, that song has value because every time the song is played on the radio, every time it's included in a commercial, every time it's on a TV show, there's money paid to the artist. The artist very often is not particularly good at promoting the use of that song. So what they can do is sell it to somebody who is good at promoting those types of things. They aggregate many of these opportunities, not just songs, but songs, ebooks, movies, TV shows, etc. They incorporate that into a portfolio, and they actively go out and promote the use of those materials in income generating opportunities. So we both participate on the equity and the financing side of those types of opportunities. And basically, we're able to generate mid-teen IRRs because we're buying them from the artist at a price reflective of what the artist is likely to generate on that asset over the life of the asset. But once you put it in the hands of people who are experienced at promoting the use of these types of things, the cash flows can increase substantially. And as those cash flows increase, the equity participation will increase substantially in value. To the extent that it's a financing transaction, very often we're including warrants in there, which will also pay us for an increase in utilization of the asset.
And so a mid-teen internal rate of return is pretty astounding. And you talked about cash flow, which that's always fresh and moving. And so that's awesome. Made me think of a question. Does that mean that you're coming into this opportunity where cash flow is already happening, and then now this collaboration is amplifying what's already happening? So you're participating in cash flow that's in place, or are you saying the cash flow should happen because we're going to do X, Y, and Z to promote it?
Well, it's a combination of both. We're talking about a portfolio approach. So very often you're talking about a new asset that's coming online that you're providing the financing for, and will have direct participation in that cash flow, or you're talking about an existing asset which is being acquired, and then you have participation in that. So it can be either or, but that's the beauty of a portfolio approach.
Yeah, yeah. And then you talked a little bit about protection, and I know that there's no guarantees 100% of, protection, but talk a little bit about some of those things that you put into place to make sure you mitigate risk as much as possible.
Sure. So one is loan to value ratio. You buy a house, you put 50% down, the bank doesn't have a lot of risk. You're not going to walk away from a house where the bank only has 50% participation because you stand to lose a substantial. So low loan to value ratios are critical in these types of opportunities. Two, senior versus subordinate. Basically, when there are cash flows being generated, if you're third or fourth in line to receive that cash flow, you're at risk, right? Because should the cash flows change, you're not going to necessarily get paid. If you're senior in the cash flow structure, then you're much better protected because cash flows can decline, and you still having first right to those cash flows generally will be very well protected. So it's senior subordination, it's structure, it's loan to value ratio. All these things go into protecting ourselves and our clients in these types of investments.
Yeah, that is that's really good, because it's kind of like when you were mentioning senior and third position. It's like in a real estate transaction. If you've got a second mortgage, or you're behind the first, if you're in third or fourth or fifth position, good luck. So I mean, being able to structure that for as much protection as possible is huge. And I know you work with both investors and their financial advisors. So talk a little bit about the benefits that you provide them, and can individual investors come to you, or do you work just with larger agencies?
No, we work with both high net worth individuals as well as investment advisors. And basically what we're advocating is for the inclusion of this type of low volatility, high yielding income type opportunity within a portfolio approach. So you don't need to look any farther back than calendar year 2022 to see why. The equity markets are down between 15 and 20% year to date, despite the recent recovery that we've had in the markets. The bond markets are down almost 15% for the year. If you're in a traditional 60-40 approach, you have lost 14% or so on your invested assets. Couple that with the fact that inflation is up, and the fact that inflation is up is one of the primary reasons that the stock and bond markets are down. You've got a significant loss of purchasing power in 2022. Our investments are designed to provide stable cash flow over the life of the investment. We structure our investments with a 3-year lockup, but the underlying assets tend to turn over fairly quickly. So as rates go up, we're getting higher rates. We're able to turn over those investments, stay fully invested, and generate both stable value, which supports the value of your portfolio, as well as high income for our clients. So if you're someone who's got wealth and you've got 5, 10, 20% of your portfolio in an income generating asset, you can take that income in times like these and not have to sell stocks or bonds at a loss in what would otherwise be a very difficult market.
Yeah, that makes a whole lot of sense. And, some of the things you'd mentioned about these opportunities and funds. Is this something where you just Google and go, show me the best fund? Obviously not, but talk a little bit about how you guys are finding these, how you are cultivating them, how you are doing your due diligence before you even bring them into your fund to benefit your advisor, your clients. So I think that's really interesting to see, like sometimes you see a high performing real estate agent that goes, I don't just go to the MLS. I've got my private book of clients and we've got these that you'll get access to that no one else knows about. So how do you guys go about finding your opportunities?
Yeah, so both my partner, Andrew Saunders, and I have been in the markets for a long time. Andrew, well over 20 years, me, well over 30 years. And we both have been in the alternative investment world for a long period of time. So A, we know a lot of people. B, we're both active investors in the space. Andrew both as an investor and a distributor of product, me primarily as an investor in the space. So we're always looking for new opportunities, people who are doing new and innovative things, because generally those new and innovative things offer a yield premium or a return premium over things that are tried and true. Right? Everybody's got money invested in real estate, and therefore it's very competitive in this space. So if somebody's lending against real estate, you're going to have lower rates. If somebody's lending against insurance, education, media, things of that nature, where it's not well understood by the market, where the masses have not invested in these types of opportunities, where banks are reluctant or because of their regulatory regime are unable to lend in that space. There are opportunities for those who A, understand the specialty lending space, and B, are knowledgeable about both structuring as well as doing due diligence on these types of opportunities. So we're constantly encountering these types of opportunities. We're constantly talking to people about what they do, and we are curious people by nature. So we're investigating these and looking for opportunities that we think will benefit us from investing in those spaces and putting our clients alongside us. So in each case, we're vetting the opportunity. We want to make sure that A, there's substantial cash flow, B, there's substantial collateralization behind it, C, there are structural protections built into the investment agreement, be it an equity or a loan type situation. And then D, we want to make sure that the character of the people we're investing with are the type of people we want to do business with. So we get to know the managers we work with quite well. Sometimes we make direct investments, but primarily we're investing with other people who are specialists in each of these areas. And really the criteria I listed are the ones we look at to identify and vet an opportunity.
Yeah, what a neat position to be in, to be able to sit down with the decision makers of one of these opportunities and be saying, we need to see if we're feeling comfortable allowing you into our, fund. And so that's really neat to kind of vet and get to know, and then probably a series of ongoing, whether it's quarterly, annually, to make sure that all of those things that gave the thumbs up on at the beginning are maintained, right? I mean, you can't just get the door and then not manage that. So you're keeping tabs on them as well.
Absolutely. Ongoing monitoring is one of the keys to success in the space. To your point,
Yeah.
things change, markets change. We need to and people change, right? So you need to stay in touch on all those fronts and make sure that the investment continues to perform as expected, that the regime that you thought was in place when you made that investment remains in place. And if there are changes, that doesn't necessarily mean it becomes a bad investment. But if there are changes, you have to understand those changes and make sure that you're aware of what the new regime might be.
And then, am I seeing correctly? Your website, you say that you guys, as a firm, invest alongside your investors. So you're not just pointing to these things, going, "You ought to put your money here." You're going, "Follow us, follow our lead. We're doing this, and we're bringing this opportunity to you as well."
Right. So after my career in the corporate world, when I set out on my own, the first mission was to invest my own capital. So I formed a family office, and that family office participates in everything that we do. And when I say the family office, it's two people, and both my money and my partner's money invest every opportunity we have.
Yep. And I think that, you hear the old cliche, put your money where your mouth is, but the bottom line is, if this was too risky of an investment, you're not putting your money in it. And why should you recommend others as well? And I know that, just like one of the mantras we know in the financial services world, focus on long-term, don't let the little bumps in the volatility make you run for the hills. So obviously all of these things are layered, and you're focusing on the long-term for, that secure return. So I think that's another aspect that you're looking at for when you're bringing these opportunities into your fund, is just to look, well down in the future to make sure that everything's smooth for your clients.
Right. Best thing we can do is be boring.
Yes. We don't want the sensationalistic news grabbing headline, "We can get you X return," because if you hear that kind of thing, run for the hills. So, seeing those, secure and really, really well thought out plans. And I'll bet you that you guys have vetted and turned down opportunities, right? So whatever the reason is, what's typically the reason that if you see a specific opportunity and you get through your vetting process, what's going to make you say, "Ooh, thank you, but no thanks, not at this time"?
Well, there are a number of factors. I mean, one, it starts with people, right? So you want to make sure that the people you're dealing with are the type of people you want to do business with over the long term. So we look for great people. We look for great opportunities. And the opportunities, what makes an opportunity great? An opportunity is great when you're able to derive a significant yield without taking significant risk.
Mm-hmm.
That's something that is not really available in the public market. Public market higher yield equates to higher risk. So really, when we turn somebody down, it's because we're looking and we're saying there's not adequate security for this investment. There's a risk. There are unknowns out there that could disrupt this strategy. One of the strategies that we've invested in that does have that really caused us to think long and hard about the external risks was the cannabis investment. So we do have some lending in the cannabis space, and one of the concerns was, what if the feds suddenly start to enforce the national laws that cannabis is illegal? States have legalized it. The federal government has not. And we went through that. We went through that with the manager. We looked at the structure. We looked at the manager's experience. We looked at the operators he's dealing with. We looked at the states he's dealing in. And we sized the position accordingly based on our assessment of that risk. So it's certainly not the largest investment in our portfolio, but we look at it as something that is really offering more yield than it does risk. So it's attractive on a risk-adjusted basis, and we feel that the risk of something going wrong that will cost us any money is extremely low.
I love it. Well, Don, I think that it's so neat to see how you guys are focusing on generating that predictable income with some specialty finance opportunities. If someone is listening to this wanting to learn more and connect with you, what's the best way they can reach out and connect with you?
Best way is either to go to our website at alt-incomesolutions.com or to email us at info@alt-incomesolutions.com.
Excellent. Well, Don, thank you so much for coming on today. It was a real pleasure talking with you.
Mike, thank you. Appreciate it.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneurssradio.com.